Hello, everyone. This is Evan here from the Trade Risk on Friday, March 11th, 2022. This is our weekly stock market analysis video series, and it's a super condensed version. I'm on the road this week, so I'm traveling, different setup, different computer, different mic, different everything. So we're going to keep this brief, and we're not going to go as in-depth as usual. We're going to just scan and tour a few different charts, a couple of the highlights from this very volatile week, and hopefully be back on schedule on usual routine next Friday with our long form in-depth market video series. So let's jump right in here. We've got TC2000. We're looking at our equity market grid, and we're looking at a weekly time frame. So we've got a custom smart trend filter applied to these charts. This is the multicolored dots, and it measures price and volume across time and helps us measure trend strength, path of least resistance. You can get access to this indicator. You can download it if you are a TC2000 or a TradingView user. So nothing changed here on this view. We've had sell signals on the market for, depending on what major indice you're looking at, anywhere from the past 3 weeks to the past 8 weeks. And the Russell 2000 initially turned down here in the final week of January, the January 21st. We got our first sell signal here, and the S&P 500 was the strongest, the last to turn down. That was 3 weeks ago. Nonetheless, all of the major indices continue in this high volatility sort of downward to sideways state at this period. So nothing changed here. If we go to the daily chart, again, you can see lots of red across these markets. You've got the Russell 2000 in the bottom left, which continues to try and show some relative strength. Even this week, it was down, I think, 1% versus upwards of 3% across some of the other major U.S. indices. So we're continuing to see the small caps, which do have, a good amount of energy stocks in there as well, which could help offset some of the broad-based kind of carnage. But generally speaking here, the S&P 500 and the Nasdaq continue in a sell signal even on this daily time frame. So let's take a look at some price action here and map out some levels. So we've been looking at a few different grids here, but one of the big sort of levels we've been staring at for the S&P 500 is this 4290 to call it 4300. That's been the line in the sand that we've been using that we want to see the market stay above. It was above it last week, despite some volatility and some indecision, but clearly violated it on a closing weekly basis for the first time this week. So we've got a cross and breakdown underneath this 4,300 zone. So that immediately puts things in a more pessimistic bucket, even in the short term for me. And if we look at a daily chart, you can see the closer indecision that's going on right here. So basically, we've got a series of attempted sort of higher lows in place. So you can see that we've got a ultimate low that we put in on the 24th of February. That was around 41.14. That's when we had the initial sort of news of the Russian invasion, and we saw markets gap down and then proceed to rally and bounce. But since that time now, we've kind of fallen back down towards those levels, but we haven't broken them. So there's some silver linings here. Even though I hate the structure, I hate the market internals, I hate the overall trend of the S&P 500, the short-term, glass half full bulls can look at this and say, well, we still haven't been able to penetrate and break below this very loud, important day here from February the 24th. So there's still maybe some hope there, or at least a place to manage risk against. If you are long this market, if you want to be long this market, well, you've got a place to manage some risk against around that 41.14 zone. So you could hang your hat on that, but generally speaking here, we're in this higher elevated volatility sort of environment in the context of down to sideways trends. If we take a look at the Nasdaq 100, you can see we've got pretty much the same thing carving out here. We've got a little bit of mixture in the short term. We've got lower highs, we've got higher lows, and notice we haven't quite violated, again, the February 24th low around 318. We're closer here, and it looks more pessimistic, but we haven't quite broken down. We're still waiting for maybe a little more directional conviction one way or the other. So you can see that kind of sideways action that we're still getting. And speaking of sideways, the Russell 2000, very much sideways here. Again, above the February lows from that day. And again, you can see a more sort of sideways, much more gradual, higher volatility state here in the small cap index. So that really remains the landscape. Lots of bearish signs there. And again, I do think the breakdown, the loss, the new weekly fresh closing low here over the past several months is again just a little more evidence in that bear case. And again, if you're optimistic, if you're short term, you've got some spots to manage risk against the 41.14 zone. Now let's take a look at a couple of other markets really quick here. A couple of notable things. We had the 10-year yield, so yields moving back up and almost back up towards the 52-week highs or the recent highs here. So we had this period where we had, treasury bonds starting to rally, and we got a good bounce off of the lows, but here we are kind of just moving right back to those lows. So that is unfortunate to see for all the treasury bond bulls, still trying to carve out some type of more meaningful bottom in these markets. You can see, of course, the US dollar continuing its gains this week. It was up 57 basis points, the UUP ETF that is, at least, and you can see trading to new 52-week high, multi-year highs here for the dollar, and again you can see closing towards those highs. Last but not least, oil here breaking down this week from its accelerated short-term trend. So we've seen tremendous amount of price appreciation here for oil, USO, the ETF that tracks WTI Brent, and for all the reasons we've discussed in the last video, of course, geopolitical events and everything else going on, we continue to see sharp increases here in oil prices. We did break that trend. We're seeing if this is going to turn into a higher low, if dip buyers are just going to kind of jump on this opportunity. So far, we've kind of gone back-to-back inside days. So we initially had that 12% down day on Wednesday of this week. We printed an inside day on Thursday. We printed another inside day on Friday. So this should lead to some interesting price action, maybe a breakout coming into Monday or at least the Sunday opening future lines. Last but not least, we'll look at the VIX here, and the VIX comfortably around this 30 zone. We've been, kind of trading, oscillating sideways between, let's say, 30 and 37 is where we've spent basically the last 2 weeks. Very elevated, point for volatility. Shows that there's lots of fear out there, shows that there's protection being bid. We're seeing it obviously in the range of the S&P 500 as we get those big, 2%, 2.5% swings up and down. So the VIX is really sort of correlating there with that realized volatility that we're seeing. So that's all I've got for this shorthand version. Again, during these periods of elevated volatility, I always sort of like to kind of preach the same reminders, is to know your time frame and know your sort of objective. For the short-term traders, this is obviously a more opportunistic type of environment. For the longer-term, swing traders, position traders, well, you might want to be just a bit more hands-off until you get some more clarity and resolution. So that's it for me for this short version of our usual market analysis video series. If you like these videos, please do subscribe. Keeps you up to date with all the latest that we're publishing, and hopefully we'll be back on track next week. So that's it for me. Take care. Thanks for tuning in, and we'll catch you in the next video update.